Thank you very much, and good morning, everyone. I'm here today with Philip Gentry, our Chief Financial Officer and Chief Operating Officer, and it's a very exciting day for Equity Trustees. So firstly, we're going to take you through our full year results for the financial year 2022, and it's an excellent set of results. But more exciting is we have announced this morning that we've entered a binding agreement to acquire Australian Executors Trustees from the Insignia Financial Group for $135 million. So the second part of the presentation, we will walk through that acquisition. But let me first start with the results. I'm going to give you an overview of the results, and then Philip is going to talk to you in detail about the financials. I'll then come back and talk about the strategy, update and outlook, and we'll take questions at the end of the whole presentation in relation to the results and in relation to the acquisition. So let me talk about FY22 and our results. Achieved a really strong earnings increase on our funds under management, administration and supervision. They increased by 3.3% to $149 billion. Now, that's a great increase against the backdrop of Australian equities being down 10% year to year, and the global equity market being down 5% year to year. So now, funds under management and administration supervision is the main driver of our revenue. Revenue was up to $111.5 million, so 10.4% on FY21, and pleasingly, about 2/3 of that revenue growth was achieved through organic growth, unrelated to market impact through the course of the year. Net profit after tax was up 12.5% on the prior year, and on an underlying basis, up 9%. We managed to manage expenses tightly. They were up 5%, and on an underlying basis, about 7%, so a really positive gap between revenue growth and expenses growth. And the board decided to increase the final dividend by 1 cent to 49 cents, so bringing the dividend for the total year up to 97 cents. Balance sheet remains in a really healthy position and has put us in a great position to undertake the acquisition we're looking to undertake. So let me move on to our competitive position. There's no doubt we are benefiting from our focus strategy on being a specialist trustee. That's enabled us to write new business in all of the lines that we're involved in, and that funds growth has flowed through to earnings growth. We have continued to invest in people and technology, and that is so important to underpinning this business. We've got to be capable, which means having the people to be able to undertake the different lines of trusteeship. There's no question the independent trustee model is becoming the preferred industry standard. There is so much focus on governance, on regulation, managing conflicts and having expertise, and we have the people and processes to do it. It's been a real tailwind to the business. The intense regulatory environment is giving, I guess, it's a two-edged sword. In one respect, it's hard work for us, but it's actually harder work for everyone else. And it gives us a really competitive edge for people looking to outsource trusteeship. And we've continued fulfilling our purpose of trust, caring for people and enriching the broader community in these uncertain times and tough times for some. But just look at the progression of funds growth over the last 6 years, and you see the trajectory is really positive. Only 1 year there where it was level, and that was after one single $10 billion client left, and we replaced it completely. But other than that, we've continued to grow the funds in each of the years and grow them strongly. Particularly, the new business in corporate trustee services this year was really strong. Superannuation has continued to go throughout the course of the year. And of course, this ending result is impacted by the lower equity markets as they were at 30th of June. So a really pleasing result when you look at that growth. If I turn to each of the business units, I'll start on the left-hand side there and look at corporate trustee services funds under supervision. You can see they've grown to $105 billion over the course of the year. They've started many new fund manager appointments through the course of the year, I think about 15 or so, established something like 60 new schemes over the course of the year. We've seen a big expansion in dual registry quoted funds, so those that are unlisted and listed. We now have a portfolio of 8 listed investment trusts, active exchange traded funds and REITs, and we have 6 in setup at the moment with some really high quality fund manager names that I'm really excited about. Finally, the growth of our corporate trust business, which is a small business but really growing strongly, had a fantastic year, as Phil will show you. Revenue's now to 3.8 million. That's a 30% growth rate in the year, and we've got 77 appointments in place in that business that we started, I remind you, just on over 4 years ago. On the superannuation side, funds under supervision were up 3.3%. We've continued securing new clients through the course of the year. Significant growth in some of our platforms that we have as clients. This portfolio now is really quite well balanced between quickly growing platforms and some, if you might call, slower growth superannuation funds that we took on a couple of years ago. So the business is in great shape and handling the regulatory load really well. And finally, if I move on to Trustee Wealth Services, the funds were down a little, mainly as a result of markets being down and also a completion of a single large estate. But despite that, we've continued writing net new business really well through the course of the year. Our investment performance has been first class, delivering great benefits to clients, and the business now is in great shape to be taking on the acquisition. Now, you hear us always talking about delivering for all of our stakeholders, and this is so important, a part of Equity Trustees' culture, to be focused on our clients, our employees, our shareholders and the community. And all of these are moving in the right direction for us. Employee engagement was up from 70 to 71%, so it's above the financial services norm. It was a great result in a year impacted by COVID so significantly. Employee enablement was up from 70 to 73%, so it's above, it's equal to the high performing norm. So I'm really happy that our staff have come back to the office and really feeling comfortable in Equity Trustees and delivering to clients. Client satisfaction side, we survey our clients each year, and their promoter score increased from +17 to +28. The net loyalty score from +12 to +41. We started surveying superannuation members in a pilot for the first time, and we've really achieved those results by focusing on some specialised client segments where beneficiaries may not be as happy generally with services, not particularly by us, but just arrangements of services. And I think that's really paid off in delivering those really positive client satisfaction results. Talked about shareholder value, but earnings per share was up 12 cents, and the dividend, as I mentioned before, up 6 cents to 97 cents. And community impact, we launched our 4th annual giving review during the year, distributed more than $92 million of grants to for-purpose organisations around Australia. Our 2 purpose-built disaster trusts, have continued to build through the year. Unfortunately, we've had more problems, with the floods across Australia, and I'm so glad we've got those trusts built so that they can actually deliver to the people who need it in those areas. I'll move on to the shareholder results and just look at earnings per share. You can see there the progression of it, up to 115.94 cents. So on a statutory result, up 11.7%, and the underlying 8.1. So it's a really healthy result, which we're delighted with. And the dividends I mentioned before, up to 97 cents on the full year. That's now 5 of the last 6 years where we have increased the dividends, and even in the COVID year, we were able to maintain it, which I don't think any financial services company was able to do, really. And this is the highest dividend we've paid in 10 years. Now, I'll just touch on the governance, risk and regulatory management, because it is core to our business. It's really important. It is what holds us in great stead, is our governance approach, our processes and people's commitment to them. We've got very productive relationships with the 2 key regulators in APRA and ASIC. No adverse actions being taken by either of those 2 regulators. We've handled all of the significant regulatory change really well through the course of the year. I see this regulatory change more as an opportunity, even though it's a lot of work for the company, but it is an opportunity because it really shows our clients where where we can add value to their businesses. Our risk culture continues to strengthen. It's a really positive shape. We survey that each year. It's so important to us, and we've kept building platforms to help us in this governance and risk oversight. I've mentioned before our enterprise-wide compliance and risk platform, CAMS, was deployed.
and we developed a proprietary member outcome assessment platform, which needed to deal with more than 500,000 member assessments and 160 different types of assessments across the portfolio of superannuation funds that we had. So I don't think anyone would have that type of stretch that they need to do in superannuation oversight, but we handled it exceptionally well. I just want to touch on our people and technology, two key drivers that enable this business. There's been pressure in the Great Resignation effect. We weren't immune to that, but unpleasingly, turnover is reducing at the moment, and we're filling the vacancies that we've had. I see that we're increasingly being seen as an employer of choice. We'll continue to manage the remuneration levels appropriately. There is some pressure, particularly in some sectors such as IT, and it's well known to everyone in Australia. I'm really pleased with the people we've secured to the business. These are critical appointments. Our company secretariat is such an important appointment for this type of business. In corporate trustee services, we employed our first business development manager, our general manager of business development. That's enabled us to accelerate growth in the RE side of the business, but also build out on the custody and the real asset side of corporate trustee services, which we've always had ambitions to do. And I mentioned that we have appointed a head of responsible investing into our investment team, and that's critical because we'll be focusing on that more in the future. And we've managed the hybrid model, returning people to work 3 days at least in the office and 2 days all on Monday and Thursday. I think that's working well for us. We were probably at the stronger end of the spectrum in doing that, but I actually think it served us well, and our employees have still really high levels of engagement and happy with how we've managed that process. Technology front, I mentioned CAMS before. We also deployed Ziegler, which is a third-party service oversight platform. That's very important to us because we have an operating model, as people will know, where we outsource many functions and retain governance, control and judgment. So that platform is proving very effective for us. We've kept evolving Salesforce in each of the business units. Cyber resilience is a constant war, which I think we're winning at the moment. Can't declare victory. And we flagged that we are replacing our client platform in Trustee Wealth Services and also replacing our finance system over the course of the next 12 to 18 months. I mentioned before the sophisticated member outcomes platform that we built through the course of the year. Let me turn on to asset management. I just want to call out the results here. We appointed new leaders into asset management just on 4 years ago. Their performance record has been nothing short of outstanding since that point. They've kept the team intact through the whole of that period. We've launched a new global equities fund through the course of the year. I mentioned appointing a responsible investing manager. We transitioned the leadership in the fixed income team from our previous leader, Lance Papulis, who retired after 40 years in the market, and we're delighted with Alistair Hood, who's taken on that role. We're starting to win business in the for-purpose sector, which is where we're focused with a new $150 million mandate near the end of the year. So just looking at the performance there, you can see Australian equities in the top block, 5% alpha over the last year and 3.1% per annum over the 3 years. That is enormous alpha generation with well-controlled risk. And you can see the peer ranking there, that we're first quartile over 1 and 3 years, almost top decile over the 3 years. And fixed income, positive alpha there, and first quartile over the last year. So that's a really clear benefit to our clients and to the business overall. So well done to our team. So in summary, the funds have grown to $149 billion. A lot of strong organic growth has contributed to that. EPS, both on an underlying and statutory basis, have continued to grow. The board have increased the dividend to 97 cents in total for the year. We're continuing to invest in the business, so it's sustainable and set for the future and set for growth. We're deepening our community impact and delivering to all of our stakeholders. So I'll hand over to you.
Thank you, Mick, and good morning, everyone. Let me just take you through the financials in a little bit more detail. Firstly, starting with some of the key elements of the P&L. Here you can see the revenue growth is up a very healthily double-digit 10.4%, one of the strongest revenue growth years we've had for some time. Expense growth up 5.1 on a statutory basis, but up 7.4 underlying, but still a a healthy margin between the revenue and expense growth. Look at the half-on-half expense growth, that's up 5.8%, relatively strong, and that reflects that investment in people and CTS and a catch-up and reduction in vacancies. More broadly, you can see a healthy increase in EBITDA and net profit before tax. Bottom line NPAT up 12.5%, and EPS up 11.7% on a statutory basis. Dividend up 6 cents on the prior corresponding period and 1 cent on the previous half. A pretty positive set of results. Now just looking at the revenue in a little more detail here. This is the traditional waterfall chart which breaks out the market impact on revenue vis-a-vis organic growth, and you can see here the pretty good performance on an organic growth basis, with good growth from all three business units. Naturally, positive markets have also assisted, albeit somewhat softer in the final quarter of the year. Looking at some of the broader performance metrics. On this slide, you can see the revenue, EBITDA, NPAT, and dividends all trending pretty positively over the last 5 years. EBITDA in particular picking up noticeably in the last 18 months or so. And just perhaps turning in to the perspective of how leveraged we are to markets and just making sure everyone understands this properly. On this slide, you can see that TWS, these percentages change a little year on year, and currently we're about 60 to 70% leverage to the average daily ASX 200 and TWS, and STS about 20 to 30% leveraged to that same benchmark, and then in CTS about 40 to 50% leverage to the average daily world MSCI in particular. Now, July, of course, markets continue to be fairly soft, but it's been encouraging to see the markets bounce back somewhat in August. It remains to be seen how the rest of the financial year goes in the year ahead. Now, looking at each of the BUs and their performance in a little more detail. Firstly, TWS. Again, here you can see on the left-hand side, solid headline revenue growth of about 7.8% on the prior year. We've adjusted for the finalisation of one particularly large estate. That's unlikely to be the case going forward. It's something of a one-off. And then you can see the FUMAS breakdown on the right-hand chart, which reflects the market impacts, in particular, the ASX down to circa 10% year on year. And then looking at some of the sub-business units within TWS, in the left-hand column of this chart, you can see the core trustee services business and estate management at the top. You can see the reduction there reflects that single large estate that I touched on previously. The market impacts mainly, despite some reasonable underlying growth in perpetual charitable trusts, advice and testamentary trusts. And on the right-hand side, some reasonable growth in most of these emerging market trustee businesses, and notwithstanding markets overall have been somewhat depressed year on year over the last 12 months. And then turning to our superannuation business. In this chart, you can see on the left-hand side, particularly strong organic growth, mainly driven by the full year impact of the appointments to Centric and Aricon, along with significant growth in Hub24. Again, organic growth, a bigger chunk of this business because there's a much higher percentage of fixed fees here. On the right-hand side, you can see the funds under supervision up, notwithstanding markets have been down. Members, of course, are down due to low balance members transferring to the ATO. Now turning to CTS. In this business, our organic growth has been the strongest. You can see headline growth here of some 16.5%, particularly strong. Large numbers of new funds. We continue to see good momentum, high levels of activity in this business, with some 30 to 40 funds expected to be launched in the second half and in the first half ahead. Strong demand across most asset classes, but on the right-hand side, you can see the growth, particularly in the non-traditional asset classes. Providing a bit more detail around our corporate trust and DCM business. On this chart, you can see the revenue, funds under supervision, and number of accounts all trending very healthily. Very good momentum in this business. Consistently strong across all metrics, and we're very encouraged by the momentum that's underway. Now turning to the UK and Ireland. Some positive trends in this business, but it hasn't been an easy 12 to 18 months. We've been impacted by Brexit, and COVID has also made it difficult for fund managers to distribute. The FCA has had a focus on the ACD market for the last 6 to 12 months, which has included us. But nonetheless, we're improving our position. We're certainly being considered by larger fund managers, and we're considering a range of options to further improve performance in the year ahead. Coming now to the balance sheet. Continues to be a very strong balance sheet. Our debt-to-equity ratio is quite low. You'll recall a large chunk of our cash is required for regulatory capital purposes, and I'll turn to the breakdown of that shortly. Suffice to say, we've got good headroom in our covenants, surplus borrowing capacity, and plenty of flexibility to take advantage of further opportunities. Turning to cash flow. Particularly strong cash flow generation here. You can see a very healthy increase there. Offset, of course, by the payment of dividends, tax, and a small number of other activities, but nonetheless leaving a very high cash position and a healthy buffer above our regulatory requirements. Next slide, I'll just spell out how that liquidity looks. If you look at this chart, and you move from left to right, you can see the total liquid assets, the reg cap required for our normal TTS business, the ORFR capital required for our super business, leaving net available cash of nearly 24 million, committed undrawn facilities of 30 million, an effective capacity of some circa 50 million. So again, strong liquidity position and well placed with plenty of flexibility. In summary then, particularly strong organic revenue growth, cost growth well managed, strong underlying momentum in EBITDA, and a healthy increase in EBITDA margins as well. Cash generation is strong, and we're well positioned to fund future growth. Now hand back to Mick to take you through the strategy.
Fabulous. Thank you, Philip. So let me take you through the strategy update and also an outlook for the business. Firstly, I'll be quick on this, but Equity Trustees is a company founded on trust, and we help people take care of the future. Our values underpin everything that we do, and we're focusing on fiduciary and trustee responsibility, protecting interests and growing people's wealth for generations to come. And when we look at Australian executors, trustees in a minute, I think you'll find very similar objectives and characteristics of that organisation. Let me move on to the business unit strategies. In Trustee Wealth Services, on the left-hand side there, you can see the first part of our strategy, and this has been the same over the last couple of years, is to achieve leadership in multiple states and more lines of business. Now hold that thought when we come to AET. Enhance our client experience, and that means more technology to enable our employees to deliver better service to clients. Build a presence in the for-purpose market, both from the philanthropy side and the investment side, and continue to invest in our platforms to improve the client experience. In superannuation, it's to build that business as that industry undergoes ownership changes and APRA's intensity continues to increase. Increasingly, we're seeing new funds start up from distribution groups, as well as existing superannuation promoters looking to exit out of trusteeship, given the difficulties of it. And we'll obviously have an increasing focus on delivering to member outcomes. On the corporate trustee services side, continue building the leadership position that we have in the funds management sector for providing responsible entity services, accelerate that growth in our corporate trust business. It's been a really pleasing start over the last 4 years or so, and the team is well set to keep building in that business and achieve greater scale and improve profitability in the UK and Ireland. I'll move on to the particular initiatives. I'm just going to touch on a few of these here. On Trustee Wealth Services, we'll be focusing on building the business development through our partners, both the legal industry and financial planners, and also the private banks. With 2 major developments on the technology side. One is a new leading platform for our active philanthropists called iFi, and we'll be looking to put that out in the market in the next couple of months. It's an exciting development. We've brought that technology across from the US, and I think it will give a great experience to our clients. Building a new platform for all of our client base in Trustee Wealth Services. That'll be a 2-year build, and this is sort of a once in a
once in a 10-year type of activity, and we're well set up to do that. Re-engineering our processes. We've been streamlining trusteeship and advice model for our health and personal injury clients. And then the last 2 points there are around our asset management business in terms of building the responsible investing capability on the back of our appointment, and then capitalising on the rating on our products and the high performance of the funds and the stability of the investment team, particularly in the for-purpose sector. The superannuation side, the industry changes are helping us. They're a tailwind to people considering outsourcing superannuation trusteeship. There are new startups increasingly coming to market that have significant scale already in some cases. We are digitising this business significantly because it's a complex portfolio, and I think we're well set up for APRA's next stage of data transformation and what they're planning to do on member outcomes. We've got a great team that's been built over the last 3 to 4 years as this business has grown really significantly, and it's really well placed to undertake what it's trying to do at this point. Corporate trustee services side, continue working with the funds management industry, both global players coming to Australia and Australian startups. I think our position as a RE provider is really strong. Keep building innovative solutions for super funds, larger scale opportunities as some managers look to outsource what they might already have as a trustee or an RE role in-house, and keep building the listed vehicle or dual listed vehicle part of the business. As I said before, we have currently 8 of those vehicles. There's another 6 in being built at the moment, and that's expanding our funds managers distribution, which is significant. On the corporate trust side, continue the focus on the debt side of the business and securitisations, as well as really putting more resource into bespoke custody and MITs for real estate assets, and continue building the momentum in the UK and Ireland. If I just move now to the technology, I think I've touched on most of these points, but obviously we need to keep abreast of everything on the cyber security side. We're digitising more and more of our business and using more data analytics across it. We've got significant projects in train in each of the areas of the business, in corporate trustee services, superannuation and trustee wealth services, as well as the finance system. So there's an investment going in FY23 of $2.5 to $3 million for these projects, and another 1 to 1.5 for FY24 that we've flagged previously. So it's a significant investment in technology, and we're continuing to build on the people front as well. Our vacancy levels were higher in FY22 than what we would have ordinarily like. We've been able to fill some of those. So we go into FY23 a little bit more resourced than what we were in FY22. There is inflationary pressures, but we feel we're managing those on the remuneration side generally. But we expect expense growth in FY23 to be elevated and then moderating in FY24 as the benefits from that investment flow through to productivity improvement and improved enhanced client propositions. Just look at each of the 3 businesses also to comment on where our current momentum is. So in Trustee Wealth Services, I mentioned before, we won a large client, the AFL Players Association, on the investment front, 2 new clients in the Indigenous Trust space in July, and we've got a good pipeline of health and personal injury clients. We've onboarded 60 new clients for advice, where we were previously just providing health and personal injury needs. The superannuation side, there's good success with platform superannuation clients, and we've got increasingly some prospective larger trustee opportunities where we're well advanced on particular projects. That portfolio now is becoming much more balanced between higher growth platforms and some of what you might describe as legacy, older style superannuation products. The corporate trustee services side, the pipeline is strong. We're currently establishing about 30 to 40 new funds. I mentioned a number of those are listed vehicles, and there's some highly prospective clients of larger opportunities coming through. On the DCM and custody side, that is growing rapidly. We've put new people into each of those businesses, and I think we're really well set for that growth. And as I mentioned, keen interest in exchange-traded funds and listed and unlisted products. So, in summary, we say, our strategy has been clear. I think we have benefited
from that strategy. As the industry transforms, Equity Trustees is in a great position with our specialised approach. We are growing in each of the parts of the business well. We continue to attract the people that we need to undertake this business. We've got a exciting IT development plan ahead of us over the next 18 to 24 months. Obviously, the equity markets have started at a lower level for FY23 than what they averaged for FY22, so that obviously has consequential impacts on our revenue. The balance sheet, as Philip said, is in a really solid position, and we've got the flexibility to fund growth as we need, and it's positive momentum for FY23 and beyond. So I'll finish there on the results for the financial year 22. And now we will move to the presentation relating to the acquisition of Australian Executive Trustees and the associated equity raising that is required for that transaction. So firstly, let me say I am delighted and excited to let you know that we have reached a binding agreement to acquire Australian Executive Trustees from Insignia Financial for $135 million. It's a business well known to us because we've seen them in the market and admired them for a long time. And it's an asset, frankly, that we have coveted for a long time. The acquisition is strategically compelling. It's a transformative acquisition for the group and particularly for our private client business. Scale increase alone provides increased revenue and increased EBITDA that is very material. It absolutely aligns to our strategy to be Australia's leading trustee company. And as I walk through this pack, you'll see it's exceptionally complementary to our private client business, both by business lines and by geography. There are synergies to be achieved, and the acquisition will be high single-digit cash earnings accretive in FY24, and on a pro forma basis, when additional investment revenue factored in, will be mid-teens earnings accretive. So the agenda as I walk through this is to just give you a summary of the transaction, give you an overview of Australian Executive Trustees, the strategic rationale behind it, the financial impacts. Philip will go through the transaction funding and offer. Philip will go through. I'll come back to conclude, and then we will take questions. So let me go through a summary of the transaction. So the acquisition is for $135 million. The implied acquisition multiple is around 12 times their standalone EBITDA of $11.2 million. The implied acquisition model will, assuming fully realised synergies from the restructure of the platform services business, which we intend to undertake, but not including additional investment revenue, is 9.2 times the FY23 pro forma EBITDA of $14.7 million. The acquisition is going to be funded by a combination of new equity and an additional debt facility. To give you an idea of the size of the business, their total funds under management, administration and supervision is $6.9 billion, and their FY22 standalone revenue is $38.1 million. The trustee services business will bring a new business to Equity Trustees in terms of small APRA funds, which I'll cover shortly. And the strategic rationale of the business is really clear in terms of enhancing our ability to invest more in our private client business, strengthening our product and service offers, and expanding our footprint around Australia. And it does provide transformative scale, which will allow significant investment in the business. Move on to the financial impacts. The acquisition is expected to deliver mid to high single-digit EPS accretion in FY24 on a cash pro forma basis, and double-digit accretion when additional investment revenues of $3.3 million are included. We'll be undertaking an equity raising of $125 million, and it's fully underwritten. It's comprising a $40.4 million institutional placement to new and existing investors, and a 1-for-6 $84.6 million raise on a prorated, accelerated, non-renounceable entitlement offer for investors. The equity raise will be conducted at a fixed price of $24 per share. That's a 5.7% discount to the last close on Thursday of 25.46, 4.7 discount to the theoretical ex-rights price of 25.17 on Thursday. It's important to note the new shares will be entitled to the final dividend for FY22 of 49 cents per share. Balance of consideration for the transaction will be funded by an additional debt facility of $40 million. That will leave our leverage ratio at 0.8 times EBITDA on a pro forma FY22 basis, which is conservative as you might expect for a trustee company. Completion of the acquisition is subject to ministerial approval to acquire AET's trustee licence, and we target the acquisition to close at the end of November of 2022. So let me give you an overview of AET. So AET, it's a 140-year-old company headquartered in Adelaide, providing a full range of trustee services to private clients and communities. It's in two parts, this business: trustee services on the left-hand side and platform services on the right-hand side. On the trustee side, you see all traditional trustee services. The biggest line of business that they have is health and personal injury, where they've been very successful over a long period of time, and also acquired National Australia Bank's trustee business 5 years ago, which had a significant presence in that space as well. They also have a great footprint in community trusts. I'll come to the other parts of the business shortly. On the right-hand side, you can see the platform services business with three lines of business: SAF, or small APRA funds, at the top, about $1 billion, and self-managed super funds and portfolio management services at the bottom two. So we intend to exit out of those two businesses over time because they do not involve a fiduciary or trustee role. But the small APRA funds, I think, will be ideally placed in our business because our trustee wealth services will have the relationship management skills to look after those clients, and our superannuation business will have the superannuation trusteeship experience to look after that portfolio business. If I just look at the national presence of AET, it's incredibly complementary to Equity Trustees. You can see the size of those bubbles there represents an indicative size of the business. You can see that Equity Trustees are primarily centred here. Well, I'm not here in Melbourne, but we are centred in Melbourne. I'm in Sydney, and we've got a good, strong presence in Sydney and Brisbane. But AET is headquartered in Adelaide and has a really strong position in the Adelaide market. It has a leading position also in the Perth market. So it means that we will have the whole southern part of Australia a leading position in each of these geographies. And it will add to our presence in Sydney, where we've been building in recent years, and also our presence in Brisbane. So geographically, it couldn't be a better fit for Equity Trustees. Let me talk about the strategic rationale of the business. I'll just go through the key investment highlights here. So it really will strengthen our trustee wealth services business and add scale across the board in every line of business we have. As I said, diversifies our geography. It's important to note that it is long-term enduring revenue. Key parts of this business are multi-decade type appointments and longer than that in many circumstances. So very similar to our own trustee wealth services business. The business on a standalone basis at the moment has a very healthy profit margin at 29% at EBITDA margin, but with the synergies achieved, we'll improve that close to our levels of near on 40%. It's an accretive transaction with synergy potential. I mentioned before how much we expect EPS accretion to be, and I'll just talk about the two areas where we expect to achieve those synergies. So firstly, on restructuring the platform services business, we'd expect to generate synergies of $3.5 million once that is fully realised over a course of about 18 months. Then secondly, additional investment revenues in relation to trustee services business, the $3.3 million expected in FY24, with some potential for that to increase in subsequent years. It importantly will provide us access to experienced staff. We admire the EQT staff that we've seen in the market over the years. In fact, tried to recruit many of them over time,
not so successfully. But we're really looking forward to welcoming their staff on board. Trusteeship is about judgment, professionalism, expertise, and it's not a deep, broad market where we can find our people. So to bring in so many talented, experienced people in trusteeship is going to be a real boost to this company, and I'm really looking forward to welcoming them to Equity Trustees. And I mentioned before the nationwide distribution footprint that it will give across all the major cities. Let's now turn to how it transforms Trustee Wealth Services for us. So you can see there it increases our funds under supervision scale from 9.1 billion to 14.5 billion. So that's a really material increase, a 59% increase. So it's the scale will really help us in that business. And you can see the mix of business changes, and I'll comment on how that mix of business changes, but it becomes more diversified as a result of this acquisition. So I turn to the lines of business. If I just start on the philanthropy side, we sit there at about $2.4 billion, and AET will add another $0.4 billion to that, bringing us to $2.8 billion. On the health and personal injury side, the magnitudes are the other way around, with our business on $500 million and their business on $2.7 billion, taking us to over $3 billion. So we have a really leading position in Australia in both philanthropy and health and personal injury, and just the revenues in those two areas are very enduring in nature. Our advice business will build to $1 billion. Our testamentary trust business will build to $1.2 billion, with similar sized businesses in that space. I'm really excited that their community trust business, they've had great success across the country, but particularly in WA, and that will build. Ours has been a small business that we've been very passionate about at $100 million, but with the size of their business at $400 million will build to $500 million and put us in a really strong position against the other players in the market. And finally, in estate management, that will go over $500 million now. So it's incredibly complementary by lines of business, just as it is by geography. Move on to just looking at it from the group's perspective. You can see our revenue will go from $111 million up to $151 million, so a 35% increase. So it's very material to the group. And EBITDA will go from $44 million up to $62 million with the acquisition on a pro forma basis. So a 41% increase. So it is significant scale for the group, which will really help us continue to invest. Combination of the analysis, you can see on the left-hand side, the mix of our business at the moment, over time, I guess, has been becoming more diversified with an equal contribution from each of our three business units. Of course, AET is all in the private client space. So on the right-hand side, you can see now that our private client business, which has our longer, more enduring revenue and perhaps more stable revenue, will now move up to 60% of the $151 million revenue, but still a really solid contribution from all lines of our business. I move to the next slide, significant value creation. I've commented on the platform services restructure, and I've commented on the additional investment revenues. If we just focus on the integration and one-off costs, we're allowing for integration costs of $22 million expected being incurred over the financial year 23 and financial year 24, with about a bit over a third of that in the first and 2/3 in the second part of that year. So we'll be employing resources to ensure a really smooth transition of this business. We've entered into a transition services agreement with Insignia, which I'm delighted to have their support in doing that. So before I move on to the next slide, this is really compelling strategic rationale for Equity Trustees undertaking this acquisition. It's an incredibly complementary business. It'll provide us with great scale, allowing us to invest more significantly than what we have been able to do. The complementary nature goes across geography and business line, and it just puts us in an incredibly strong position going forward. I'd just like to comment on a strategic alliance that we have entered into with Insignia, and I'm delighted that we've been able to do that. It will enable both the parties to leverage their best-of-breed products and services. So Insignia's best-of-breed products in advice and platform and asset administration and investments, and Equity Trustees, best of breed products in terms of trusteeship. I think it's a really great opportunity for Equity Trustees, given the enormous footprint of the Insignia Group in terms of their advisor network and their enormous client base. So I believe we can both leverage our market-leading capabilities in these areas. And the initial term of this alliance is for 5 years. So I'll stop there, and now I will hand over to Philip to talk about the financial impacts.
Thanks, Mick. Let me just sort of take you through some of the key points on the financials here. On this slide, I think Mick's touched on how it will enhance our private client business. On the synergy front, really two key sources of synergies. Cost synergies from the platform restructure and exit of those businesses of around 3.5 million. And then revenue synergies from additional investment revenues in FY24 and beyond. Mick said, EPS accretive mid to high single digits, accretion on FY24 on a pro forma basis, and double digit when the additional investment revenues are taken into account as well. From a dividend standpoint, our current policy remains in place at paying out 70 to 90% of statutory NPAT, but the board will give consideration to any adjustments for one-offs and the like that may be appropriate, or on a cash basis over FY23 and 24, noting there will be some significant integration costs over that time. The sheet remains relatively strong. We still have at least 30 million of committed undrawn facilities, and the gearing levels remain relatively modest. The next slide here, you can see the pro forma FY22 financial profile. Moving from left to right, the EQT numbers, the standalone AET numbers, the combination, the net synergies, which include both those cost and revenue synergies I touched on, and then the pro forma. Now moving on to some of the transaction funding and offer details. Total of 165 million being raised through a combination of 125 million of equity and 40 million of debt. Of the equity, 40.4 an institutional placement to new and existing investors and 84.6 and a 1-for-6 accelerated pro rata non-renounceable entitlement offer. 4.7% discount to TERP. And then how the sources and uses of this particular funding. On the next slide here, you can see the consideration of 135 million, transaction costs of about 8 million, and integration costs of around 22 million. Around half those integration costs are associated with the platform restructure. A decent chunk of them are associated with the technology integration. And of course, some of them will be associated with the costs associated with the TSA. And finally, some of the equity raising details and a bit more, with a bit more detail there. You can see the offer size and structure, the price, the record date, and the like. I won't go through all of that. I'll leave that for you to review in your leisure. Likewise, on the timetable, they're relatively self-explanatory, aiming for completion on 30 November. I'll pass back to Mick to just conclude the presentation.
Okay, well, thank you, Philip. I'll be 30 seconds. This is a transformative acquisition for Equity Trustees, and it's going to deliver for all of our stakeholders. It is a unique opportunity. We're delighted to have reached agreement with Insignia to buy Australian Executors Trustees. It's going to be earnings accretive, really complementary business to ours, and we're really looking forward to taking the business on. I'm happy to take any questions.
Thank you to Mick and Philip for the presentation so far. At this time, I would like to remind everyone, in order to ask a question, please press star, then the number 1 on your telephone keypad, and we will pause for just a moment to compile the Q&A roster. Your first question comes from the line of Nick McGarrigle from Barrenjoey. Your line is open.
G'day guys, thanks for taking questions. Maybe just on the result itself before touching on the acquisition. Can you talk through the margin in TWS? It obviously seems to have gone up quite a bit, but was there some reallocation between TWS and STS because the margins there seem to have gone in different directions?
Hi Nick, no, there wasn't any reallocation. TWS has had a pretty good year. Its revenues have been strong and its costs have been particularly well controlled, sort of low single digits increases there. So it's had some opportunity to expand margin. SGS, conversely, been a fair bit of continued investment to make sure we can stay on top of all the regulatory requirements there. So it simply reflects the relative performance of the businesses.
And just in terms of the technology investment, you've flagged the expected expense for next year and the year after, but was there much of that embedded in the FY22 result already, or has it been difficult hiring people to undertake that work?
No, there wasn't a lot embedded in FY22. And we've made some progress filling vacancies, including in technology, but there's still more work to be done there, Nick.
And then maybe if you can just make some comments on CTS, that seems to have had a good result in terms of its margin there, and debt and securitization has added a number of accounts. So can you give us a sense of the pipeline on new growth for that business?
Yeah, CTS had a really great year in FY22, and it's started FY23 on a similar vein. I think the funds management industry is dynamic, and there's new managers coming to Australia all the time. We're winning more than our fair share, I think, and I think also there's new asset classes being developed. I mean, not new asset classes, but a change in asset class going on to alternatives and more fixed income type of strategies. And so we've got at the moment 30 to 40 funds in the process of being established, of which I think 6 of those are listed vehicles. So there are obviously long-term structures that are being put in place here, and looking to secure more retail flow, which is stickier. So it's in good shape, and we've continued securing people into our corporate trust business. I'm really happy with the general manager for business development. He's got a custody and real asset background that is helping us, and you saw more than 30% revenue growth in that corporate trust business. So that was our plan 4 years ago. It's starting to come to fruition. Yeah.
And just, I'm not sure if you can elaborate a bit further on the comments about consequential impacts on revenue, but maybe it's the daily average FUM mass is different to what we can calculate externally looking at spot averages, but just how you're thinking that has an impact on revenue for 23?
Look, it's simply the maths. There's making sure everyone understands how it works, and obviously the average daily is important rather than the spot. And obviously, if the markets are either up or down in a sustained way, that has a consequent flow on impact on revenues.
And I mean, you haven't sort of given us enough detail there to work out what the average daily FUM mass was, but I'm assuming you're sort of saying that between the ASX and the MSCI, that gives us enough to run with in terms of that mark to market on a sort of day or month basis.
That's right. Yeah.
And I think in the result presentation you indicate $54 million of available liquidity, and I presume that's before the $40 million being taken on as part of the transaction.
That's right.
And then I guess on an extension of that, you're also raising money to undertake the transaction. So there's going to be a significant amount of available liquidity in dollar terms. Are there further opportunities that you're looking at beyond the AET acquisition?
Well, look, I mean, we've said before we're interested in businesses that are trustee businesses, and there's nothing we're sitting there looking at right now, but we always have our eye out for trustee businesses that would be complementary to FYR Trustees.
Just to add to that,
and across,
yeah. So, just to add to that, probably fair to say there's nothing imminent, but there's certainly possibilities that which have potential.
Yeah. Okay. Great. And then just on the transaction itself, can you just run us through, in terms of business lines, the overlap and where you're acquiring new capability? particularly health and personal injury, and just giving us a sense on how that business works functionally?
Sure. Okay. Well, I guess the one area we're acquiring, or two areas we're acquiring capability, I think the small APRA funds. So, we don't have that line of business. That's a new line of business for us. I think also I'd say we're adding capability in the community trust side. They've got a much bigger business, and these are quite complex, a lot of these trusts, and so we're looking forward to having that team on board. In the health and personal injury side, I wouldn't say we're adding capability because we've got solid, presence in Sydney and Brisbane. We're adding a lot of scale to it, but how that business works is through, court awards being made to individuals who have suffered injury, and the court's putting in place a trustee to look after their interests. And so, it's business that doesn't really change between the trustees. Once the court is appointed, the only way to change would be to go back to court, which is a costly exercise. So, most of the business is referred through, the legal industry to the trustees, and clients make their own choice generally as to who they want as the trustee at the start. When I say clients, I mean the individuals and their carers and representatives. Yeah.
So in terms of on the spectrum of stickiness across that TWS business, it's sort of at the stickier end of business.
Yeah, it's they don't change trustee very often. Yeah, because it's a costly exercise, and it would mean a breakdown in relationship has occurred. It's probably not likely to occur, with clients that require such high levels of service. Yeah.
Great. I might just leave it there and let someone else ask questions.
Thank you, Nick. Your next question comes from the line of Nick Burgess of Ord Minnett. Your line is open.
Yeah, good morning, Mick and Philip. Congratulations on a really strong result and the acquisition, obviously. Just a couple of quick questions on the deal. Just how should we think about asset allocation of the AET business overall? And secondly, what are the regulatory capital implications of the acquisition?
Perhaps I'll take the first and take the second. Our private client business is very skewed towards Australian equities, but the AET business will not be as skewed towards Australian equities because the health and personal injury portfolio is going to be more balanced and diversified than what we would do for our perpetual charitable trusts, which tends to dominate each of our respective asset allocations. So it'd be less, if you like, correlated to Australian equities in our business. I'll let Philip focus.
More like a balanced portfolio rather than a growth portfolio, I guess.
Yes, yeah, there will be more of a balanced nature to it. Yeah, because in some cases the capital is able to be drawn down. So when that's the situation, you can't be 100% in Australian equities. So that's the reason for that. Yeah.
I mean, roughly, what would be an allocation to equities, if you're able to say at this point?
I don't have that in front of me, Nick. I don't have that in front of me, but we can get that information. But it's it's probably going to be still over considerably over 50% into equities, and a little bit more diversified between Australian and global. And yeah.
Yep. Okay, that makes sense. Thank you.
Just on the regulatory capital question, Nick, there are two dimensions to this. One is in relation to the small APRA funds, where along with all superannuation trustees, there's a requirement to have ORFR capital. And there's about 2.6 million of cap coming across with the acquisition associated with that. And then there's the usual sort of capital required for the regulatory licenses of around 10 million of NTA. That'll obviously come across as well. And over longer periods of time, there is an opportunity to consider a consolidation of licenses, which may allow the release of some of that capital, but that'll be it won't be in the near term. That's probably a few years away.
And so, how many licenses are coming across, or how much capital do you need on those licenses that are coming across?
About 10.
10 licenses or 10 million of capital?
Sorry. 10 million. Sorry,
10 million.
10 million of capital. Okay. All right. That makes sense. Yeah. And just one final question, just on the result. Just on the revenue margin in the TWS, that large estate that was wound up or finalised, do you earn revenue on the back end of those sorts of activities, and therefore in the second half you might consider that the revenue earned is perhaps a little bit higher than the underlying run rate of the overall estate management business?
Tends to be progressive. No, it shouldn't be unduly back-ended.
No. Yeah.
Okay. So nothing abnormal to read into that.
Nothing abnormal. No.
Okay. Thanks very much.
Thank you, Nick. As a reminder, if you would like to ask a question, please press star 1 on your telephone keypad. And your next question comes from the line of Philip Pepe of Shaw and Partners. Your line is open.
Hi guys, congrats on the result, and even bigger congrats on the acquisition. It looks like a very good fit. Just question on the synergies, and apologies if this is naive, but the platform services restructure and bringing some of the funds in-house, I would have thought both of those are available to the vendor. I guess, is it a matter of different strategies or better execution? So why hadn't they considered this? How are you guys going to eke out the synergies when the vendor hadn't or chose not to?
Yeah. Good question, Philip. Well, I think it's perhaps not as clear on the first point in terms of portfolio services, and also they don't have superannuation trusteeship in their business, right, as a business. So I think us looking at it afresh, we can see that business could be transformed. The part that we're taking on, the small APRA funds, and if we exited the others, then we would be in a better position. So on the second point, in terms of the investment revenue, well, they don't have the same investment model as us. So they run a multi-manager type of investment option, and they do have it running through their not through AT, but through the broader Insignia Financial Group, whereas we obviously have it here in our business, and we don't run a multi-manager, we run an in-house proprietary team. So, that's really the difference there.
Very good, thank you.
As there are no further questions at this time, I would like to turn the call back over to Mick O'Brien for closing statements.
Fabulous. Thanks very much. We'll appreciate the questions from everyone, and appreciate everyone's attendance this morning. It's an exciting day in Equity Trustees history and also in AET's history. We're both 140-year-old companies, and this is, I think, a major coming together of two first-class companies, and we're really looking forward to getting it complete, and hope that investors have the same degree of excitement and confidence in the organisation. So thank you very much for attending this morning.